Are there similarities between inflation and Harry Potter's Lord Voldemort? Yes. In the Harry Potter franchise, Lord Voldemort is considered one of the strongest wizards of his time. Before Harry Potter is born, Lord Voldemort and his cronies terrorize the wizarding world. In his attempt to consolidate power, he hears of a prophecy. Prophecy speaks about a child that is about to be born that has the power to stand up against Voldemort and ultimately defeat him. Fearing this new challenger, Voldemort enacts a plan to kill Harry Potter before he can become a threat to him. Voldemort creates a self-fulfilling prophecy when his failed attempt to kill Harry Potter ultimately gives Harry the tools that he needs to defeat Voldemort in the future. You may be asking, what does this have to do with inflation? Well, a concern with the elevated inflation in the economy is this notion of inflation expectations. That is, what do the market participants believe inflation will be going forward into the future? The main challenge here has to do with prices that firms are setting when they sell their goods and services. There are a couple of different factors that they have to look at when they are setting those prices, and those come with a cost. The decision to decide what price to charge for a good is not a straightforward task. You have to consider wages, input costs, and also future changes to those different inputs. Secondly, you also have to consider maintaining customer loyalty and sort of that brand affinity. If you change your prices too much or too high, customers hate price increases, and that causes them to be upset further with the company. Due to these considerations, there is some stickiness to price changes. There's research that's found that firms will generally change their prices every 4 to 7 months. So if you kind of consider that half-year time frame, that means when a company is setting their prices, they have to look forward into the future and sort of determine what they expect the environment will be in the future. So looking at it from an inflation perspective, if the firm believes that the inflation will be high in the next 6 months, then they're going to set their prices high today. And that means inflation goes up. And this sort of feedback loop creates that self-fulfilling prophecy of higher inflation due to high inflation expectations in the future. So looping back in our earlier analogy, if the firm is Voldemort and they expect that inflation, Harry Potter, in the future is going to destroy them or destroy their profits, then they will take the steps now to try to defeat that inflation by raising their own prices to cover themselves. And as a result, the self-fulfilling prophecy happens for the greater economy, where our inflation goes up because firms expect it to go up in the future. The Federal Reserve is the one in charge of breaking the self-fulfilling inflation loop, and they do that through sort of two measures. First, they signal to everybody what their target inflation is. In 2022 and into 2023 now, they have made sure everyone expects inflation to return to their 2% target soon. To show that they were serious, the Federal Reserve has begun an aggressive interest rate hiking policy over the last year plus. They have risen rates from a target of 0.25% all the way up to 5% now in March of 2023. The raising of interest rates should slow down the economy by, one, reducing demand as higher interest rates induce people to save rather than spend, and then on the business side, slow things down as the cost of borrowing makes investment and expansion a little bit more difficult and slow the economy that way. The question then becomes, has the Federal Reserve's policies so far been effective at slowing inflation rates? When we look at the Federal Reserve's survey of consumer expectations, The latest data we have is for February of 2023. Looking 1 year prior at February 2022, we can see that the 1 year expectation forward was 6%, and now in February of 2023, it is 4.2%. So the inflation expectation has decreased, but it is still double that 2% target the Federal Reserve does. And when you look at the 3-year expectation, it dropped from 3.8% down to 2.7%, so also above that 2% target that the Federal Reserve has. When we look at the Fed's preferred measure of inflation, personal consumption expenditures excluding food and energy, we see that the latest data shows that inflation increased 4.6% year over year in February. So still above that 2% target, meaning they have more work to do. This puts the Federal Reserve in a bit of a tight spot. They know that they have to raise interest rates to continue to slow down the economy, but if they do so too aggressively, risk forcing the economy into a recession. And keep in mind the sticky nature of the price setting by the firms that will be slow to respond to the inflation expectations. So it's kind of a balancing act that they have to take not to break the economy. Now, one factor that we haven't talked too much about is the current banking crisis that the economy now faces. That, I think, will help the Federal Reserve in their slowing of the economy, because those smaller banks that do a lot of commercial lending will be more stringent in their lending requirements, which will effectively be like raising the interest rates because it will make it harder for businesses to get those loans. I expect that the Fed will continue to raise their interest rates, albeit at a slower rate than they have done over the last year, as they sort of see how these different factors play out. The Fed is committed to stopping Voldemort from committing the self-fulfilling prophecy of further inflation on the economy, and they will use the full power and tools at their disposal to do so.